In May of 2026, a relatively under-the-radar tech stock went on a vertical parabolic ascent. The company is Innodata, ticker symbol INOD. We're talking about a move that basically stunned analysts and completely re-rated the company from a legacy data processor into a multi-billion-dollar enterprise. Welcome to this explainer. Today, we're going to break down the dramatic financial story behind what is quickly becoming the picks and shovels of the generative AI boom. We'll explore the undeniable structural tailwinds, the staggering cash flow metrics, and maybe most importantly, the hidden, potentially existential risks that are currently pricing this company for absolute perfection. Okay, let's dive right into this. Our agenda today covers 6 parts: the AI gold rush, the great AI pivot, Innodata's explosive growth, the giant catch, insider cashouts, and finally, the verdict. Section 1. The AI gold rush and the essential supply chain for hyperscalers. So, right now, massive hyperscalers have effectively exhausted the supply of high-quality, publicly available internet text. To build the next generation of agentic AI, the kind that can actually reason and execute multi-step tasks autonomously, they've hit a severe data scarcity wall. They desperately need high-quality, ethically sourced, human-validated data. And this brings us to a really crucial concept: reinforcement learning from human feedback, or RLHF. This is the critical mechanism that separates raw, unpredictable, and sometimes hallucinating AI foundation models from safe, usable consumer products. You can't just use automated scripts for this. It requires high-cognition, human-in-the-loop services. We're talking about literal subject matter experts: doctors, lawyers, scientists, financial analysts, evaluating, fine-tuning, and aligning the AI. Well, Innodata provides exactly this essential, highly specialized human infrastructure, acting as the indispensable picks and shovels for the global technology giants. Section 2. The Great AI Pivot, moving from legacy data to frontier AI engineering. Innodata capitalized on this structural demand by fundamentally transforming their entire business model from the ground up. The old Innodata, it was heavily tied to legacy business process outsourcing. Think low-margin, offshore data labeling, like literally drawing boxes around pedestrians for early self-driving cars. It was essentially a race-to-the-bottom labor arbitrage model spread across fragmented segments. But the new Innodata has entirely abandoned that. They are now an elite partner for generative AI developers, focusing on high-margin AI data engineering, supervised fine-tuning, complex agentic data sets, and they're even launching their own proprietary AI evaluation and observability platforms. Now, proving this massive pivot wasn't just talk took some time, and a major milestone happened on April 27, 2026. A U.S. District Court officially dismissed a persistent securities class action lawsuit. This suit actually stemmed from a 2024 short seller report that accused Innodata of AI washing, essentially claiming their AI capabilities were just smoke and mirrors designed to hype up a decaying legacy business. This legal dismissal was absolutely monumental. It fully neutralized that reputational overhang and proved to institutional investors that Innodata's technological capabilities and their subsequent revenues were totally genuine. Section 3. Explosive financial growth and textbook operating leverage. With the legal clouds completely parted, Innodata delivered a Q1 2026 earnings report that absolutely floored analysts and triggered a violent stock inflection. Just listen to this top-line acceleration. In the first quarter of 2025, they generated $58.3 million. By Q1 2026, that skyrocketed to $90.1 million. That is a staggering 54% year-over-year revenue expansion. This didn't just beat Wall Street consensus expectations, it completely dismantled them by a massive 18% margin. Demand is so robust that management confidently raised their full-year 2026 revenue guidance to an exceptional 40% or more growth rate. But top-line growth means very little if you're burning cash to get it, right? That brings us to this magic number, 28%. That is Innodata's adjusted EBITDA margin for Q1 2026, printing at an incredible $25.0 million. This metric literally doubled year over year and crushed Wall Street's estimates by 139%. Why? Because of textbook operating leverage. As they scale up these high-margin AI services, their fixed corporate overhead is being absorbed over a substantially larger revenue base. That means every new dollar coming in is flowing aggressively right to the bottom line. And that bottom line profitability, it is translating into real distributable cash. In just the first 3 months of 2026, Innodata generated a record $34.8 million in free cash flow. To put that into perspective, they generated almost as much free cash flow in 1 quarter as they did in the entire year of 2025. This has forged a total fortress balance sheet. They are sitting on $117.4 million in cash and hold absolutely zero debt on their $50 million revolving credit facility. They have basically created a pristine, self-funding financial machine. When you compare this transformation to the broader market, the contrast is stark. Innodata is currently commanding an astronomical 80 to 85 times trailing PE multiple and roughly 10 times price to sales. Meanwhile, look at traditional legacy competitors like EPAM Systems or TaskUs. They're trading at severely compressed single-digit multiples. The market is actively punishing those legacy IT and customer experience firms over fears that generative AI will cannibalize their billable hours. Conversely, Innodata is being rewarded as a massive structural beneficiary of the AI capital expenditure wave.
Section 4, the giant catch, an existential customer concentration.
Okay, beneath all these incredible financial metrics lies a terrifying structural fragility. In Q1 2026, a single unnamed technology customer accounted for a massive 56% of Innodata's entire revenue. A second client accounted for another 17%. That means nearly 3/4 of this entire company's cash flow is derived from just 2 corporate entities. This makes them dangerously vulnerable. If just one of these hyperscalers decides to pause their model training, alter their AI architecture, or build internal annotation tools, Innodata's revenue would experience an immediate and catastrophic contraction. Management is acutely aware of this risk, which brings us to what we can call the $51 million lifeline. During the recent earnings cycle, they finalized a new 2026 engagement with a major big tech customer, a customer that provided zero revenue just 12 months ago. If this specific hyperscaler scales successfully throughout the year, it'll provide vital dilution to that 56% concentration risk. Honestly, it's the single most important operational metric that institutional investors are watching like a hawk right now. Section 5. Insider cash-outs and high-volume corporate profit-taking. Whenever a stock undergoes a multi-week parabolic surge like this, executive behavior offers an unfiltered lens into corporate sentiment. Let's trace the recent timeline. On April 27th, the stock was sitting comfortably around $41.83. Then came the earnings blowout on May 8th, sending shares surging past $84. By mid-May, the momentum hit a fever pitch, striking an intraday 52-week peak of $114.77 before stabilizing in the mid-90s. It was a historic rally. And it was precisely at this valuation peak that executives decided to hit the sell button. This timing becomes even more fascinating when you dig into the SEC Form 4 filings, specifically from CEO Jack Abuhoff. In mid-May, he executed a massive series of trades. First, he exercised heavily in-the-money options to acquire 250,000 shares at a strike price of just $4.99. Second, he immediately sold those shares onto the open market at prices ranging from $93 to over $96. The result? He netted approximately $23.7 million in gross value. Alongside him, director Stuart R. Massey also sold shares, cashing out around $1.85 million. Now, objectively speaking, it's totally standard financial practice for executives to diversify highly appreciated equity positions, especially for retirement planning, which was cited in the filings. It's also worth noting both men still retain massive equity stakes in the company. However, the sheer magnitude, the timing, and the synchronization of these high-volume sales strongly signal that leadership rationally recognizes a near-term valuation ceiling. They understand that the current public market price has fully digested the immediate operational upside and years of future growth expectations. Section 6. The final verdict on a strictly balanced risk-reward. So, where does this leave us when we weigh spectacular operational execution against extreme stock pricing? The crucial point is summarized perfectly by this equity research quote. The stock is meticulously priced for absolute perfection. At a $3.1 billion valuation, commanding an 85x PE multiple, while still carrying 56% concentration risk in a single client, there is absolutely zero margin for error. If there is even a minor delay in hyperscaler AI spending, or if well-funded private competitors like Scale AI initiate an aggressive price war, the resulting multiple compression from these elevated levels would be absolutely devastating to shareholder value. Which leaves us with the ultimate question. Will Innodata's proprietary platforms and that new $51 million revenue diversification effort scale fast enough to outpace the inherent looming cyclicality of hyperscaler AI spending? Until this precise question is answered definitively in the upcoming Q2 and Q3 earnings cycles, the broad consensus among analysts is that this incredibly fascinating company is a strict hold. What do you think?
Are they the definitive picks and shovels of the AI revolution, or is the concentration risk a ticking time bomb? Thank you for joining me for this explainer, and keep learning.